The US Federal Reserve has penciled in at least 2 interest rate hikes by 2023, indicating that they anticipate a strong 7% economic growth in the US this year, as well as a rapid inflation and job recovery. The statement came after policymakers held their Federal Open Markets Committee meeting on Wednesday. And although the central bank left the benchmark rates at near zero as expected, observers were on the lookout for clues of whether officials were now talking about winding down their monthly bond purchases worth $120 million to stimulate America's pandemic-struck economy. We discussed what the latest meeting signals for the course of monetary policy in the US and its impact on South Korea. For this, we connect with Andrew Levin, Professor of Economics at Dartmouth College, who worked as an economist at the Federal Reserve Board for 2 decades, including 2 years as a special advisor to Janet Yellen, the current Treasury Secretary. We also have Kim Jin-woo, Professor of Economics at Korea University, who formerly served as a senior economist at the Federal Reserve Board's Division of Monetary Affairs. A warm welcome to both of you. Thank you for joining us. And well,
morning. Good evening to Andy.
Yes, good evening to Professor Levin, and good morning to you, Professor Kim. Now, Professor Levin, there seems to be a lot to unpick from this meeting that just ended a few hours ago. And as anticipated, the Fed didn't offer very clear remarks on whether it would start talking about reducing its balance sheets. But with its rate hikes, though, with them penciled in earlier than many expected, do you think this signals that the Fed is more worried about inflation than they've let on in the past few months? I mean, what does this tell you about their position on tapering?
Sure. Well, so I think the first thing to talk about is the data, because the Federal Reserve, that's ultimately what's determining their decisions. They try not to get anything set in stone. They want to keep watching the data carefully. So as of a few months ago, the Federal Reserve was anticipating that inflation would pick up moderately this year. And part of the reason for the pickup was just a pure measurement issue that it's a 12-month change. Inflation was extremely low early last spring and then picked up a couple months later. So as that 12-month window moves forward, they were expecting to get a pickup. What they weren't expecting and what we've been seeing is very strong numbers, not just for commodity prices, but for what we call the core inflation rate, which means all the basic items that consumers buy, and across a very wide range of goods and services. Core inflation is now picking up. It looks like for the first half of this year, it's going to be close to 5%, which is well above the Fed's target. Remember, the Fed has an inflation target of 2%. So I think Chair Powell in his press conference, emphasized they still are hopeful that inflation will come back down pretty quickly, in which case no change in their action plan would be called for. But a lot of people in the markets, and certainly business people, and a lot of consumers actually are expecting that inflation is going to stay high for quite a while, and that there's a risk that it could go up even further, in which case the Fed's going to have to move. It's going to have to change course, and it's going to have to do it pretty quickly, and it's going to have to explain that in a way that doesn't disrupt financial markets.
Right, so the Fed's been under a lot of pressure to start talking about tapering. And well, Professor Kim, now the Fed Chair, Jerome Powell, he's continued to say that the sharp surge of prices is likely to be transitory. But the New York Fed released a survey this week showing that consumers expect inflation to hit 4% this year. And that's actually the highest reading since the survey began in 2013, and also above what policymakers have been forecasting, even with their recent revision. So what is your outlook? Do you think prices are going to stabilize in the short term, or would you say the customer is right on this one?
So as it comes to, maybe both are right in the following sense. As Andy mentioned, the inflation forecast for the year of 2021 for the PCE inflation was like 2.4% in March, but now the median number is 3.4%. A few days ago, when I was reading the newspapers, Korean IBs are expecting around high twos, like 2.7, 2.8 numbers. But today, it turns out that the median projection is 3.4%. And then the range goes all the way down from 3.0 to 3.9. So as Soo-young, you mentioned, 4.0 number is within that range of the projection by the FMC participants as well. So depending on how persistent in terms of how many months does its high inflation go, I think some are expecting 3.9 even within the FOMC. So the median of the New York Fed survey, which is from more than 1,000 the households, I believe, is not outside the bound of it. So depending on where you are and what you view, or whether you think of the CPI or PC inflation, that's a small difference. So that's how I would look at how much the contour of inflation projection relative to 3 months ago.
And Professor Levin, you warned earlier this year, actually, that the Fed's PC projection in the 2% range was too optimistic, and that if current trends continue, then the US could see a much higher core inflation than expected. And now that they've adjusted their inflation forecast to the 3.4% level, do you think it's a bit more realistic now?
Well, the irony is that they caught up to what I was expecting 3 months ago. But the actual inflation readings have been continuing to accelerate. So as I said, it looks like for the first half of this year, core PC inflation for the United States is going to be around 4.5% to 5%. So just think now for a moment, what would it require in order for the Fed to rewrite that core inflation for the year as a whole is down around 3%? Would mean that starting in July and August, we'd have to see very sharp decline in core inflation month to month, back down to around 1%, so that the average for the year, the first half, remember, is around 4.5 or 5. The second half would have to be down around 1 to 2% range in order for the year as a whole to end up at 3 or 3.5. I don't see it. If anything, it looks like from the last several months that the core inflation is continuing to move upward. So we could see numbers this summer that are in the 5 to 6% range. The Fed is going to have to move. It's going to have to start tapering sooner than they would like. At the press conference today, Chair Powell kept emphasizing that they want to give plenty of advance notice before they taper, because he's very uneasy about having another taper tantrum and potentially having a very sharp stock market correction. But if they've got to move, they can't be behind the curve on inflation. The reason for that is because if they keep interest rates at 0 and inflation's rising, that makes the actual policy more and more accommodative. Professor Kim and I have talked about this many times over the years. What we call the real interest rate is the interest rate after you've adjusted for inflation. So if inflation's rising, the real interest rate is actually declining. This is something Professor Taylor at Stanford was the one who really identified. In fact, it's called the Taylor principle, which is as inflation's moving upward, it's critical for the central bank to move quickly to stay ahead of the curve.
Professor Kim, it looks like there's a lot of attention on the job figures here. The unemployment rate, it continues to stand relatively high at 5.8%, and the economy is still around 7.6 million jobs short of its pre-pandemic levels. So it seems that Mr. Powell is remaining a bit cautious before rolling back bond purchasing. But you've mentioned that there seems to be a disconnect in the relationship between the labour market and inflation. So would this potentially complicate decision-making for central banks? And what would you constitute as a sufficient recovery to actually begin tapering?
I mean, that complication was reflected in the press conference today as well. I think the first question from the media was about exactly the labor markets, and Chair Powell was answering by referring to the inflation rate, unemployment rate, and the employment numbers, and the labor participation rate. And basically, when economists talk about unemployment rate, we only count people who are willing to work. If somebody became unwilling to work, then that person is not included in unemployment anymore. And that complicates the analysis. And that's the source of one source of the complication Andy and I, we all economists have, and also the Federal Reserve or FOMC participants are facing as well. And it all depends on how people would behave after we overcome this pandemic. In some countries like the US, they're taking off masks and they go to work. but there is a conflict between workers and employers about whether the workers should return to the office or staying at home. All the complications would result in how much people are willing to work, and that's the labor force participation. Andy has a paper on that, but the complication would be even more severe when we are overcoming the pandemic in the next couple of months.
So as cautious as officials are being, Professor Levin, now we've seen a lot of ambiguity around in the officials' remarks made in recent weeks. And well, you advised Janet Yellen on monetary policy a decade ago, actually, and she said recently that tapering could be good for society and the Fed. What do you think she means or really has in mind?
Well, she was talking about the level of interest rates, and the truth is, when you have a healthy economy, what we call balanced growth, means the economy is growing at a steady, sustainable pace, and people who want to be working can find a good job and get a reasonable pay, and the inflation rate's low and stable. That's the kind of ideal situation that the central bank is really trying to achieve, trying to foster those circumstances. And if the economic growth is strong, then the level of interest rates that goes with that kind of balanced growth can be relatively high, and that's good for investors. It's good for savers because it means they get a high return on their savings, makes a more comfortable retirement when they're ready to retire. A challenge in the United States and many countries around the world over the last decade or two is interest rates have been very, very low, in some places even negative, which means it's difficult to be trying to save for retirement. So Dr. Yellen was trying to emphasize that point. There is an upside to having a higher level of interest rates. The downside is that when, as you noted, the labor market's still not fully healed. There's still a lot of people who were displaced. Their business closed last year. That business is not going to reopen ever. The owner of the business might have been retired and moved to Florida. Those workers need to find new jobs. Sometimes they have to move to a different sector of the economy. Sometimes they have to move to a different location. It's not easy to do. It takes time. What we're seeing in these last 6 to 8 months is a pretty steady job growth rate of around 400,000 new jobs per month. And that needs to continue for 2 or 3 more years to fully heal the job market. As you mentioned, 7, 8, maybe 9 million people still need to find work and get back to work. That's going to take some time. The problem is, if inflation's really rising and inflation expectations are picking up, the Federal Reserve has a dual mandate. It has to make a balance between keeping inflation low and stable and trying to promote maximum employment. That means the Federal Reserve might need to raise interest rates to some degree sooner than it would wish, and that's going to slow the economy somewhat. And so there's some trade-offs here, and the Federal Reserve is going to have to face those trade-offs and explain as clearly as possible to the public and to the United States Congress what it's doing and what its plans are and how it's making those decisions.
Right, so a lot of clear communication. Well, many are hoping to see that come across from the Fed officials. And just a correction to something I said earlier, that Dr. Yellen was talking about tapering, but she was actually referring to an increase in interest rates as being beneficial for society. So I apologize for that. And well, Professor Kim, over here in South Korea, market watchers have been rather nervously watching how these tapering talks are going to progress. And they expect the Bank of Korea to consider raising its benchmark rate. So how would you advise the central bank here in terms of the speed of raising its key interest rates, and what are the factors or the risks that you think should be taken into account?
So when Korean financial markets are watching the Bank of Korea, it's one of the key factors is the movement of the capital over the different countries. And Korea was hot right on that in 1997-98. And in the taper tantrum episode of 2013, Korea was in the hot spot as well. So that's why the Korea in general and the Bank of Korea is watching the movement of the US Federal Reserve very, very closely. In some sense, too closely, I sometimes say. But this case, because it's the tapering stage, for the Bank of Korea, they did not do the real QE. So for Korea, the reverse of the tide is the interest rate hikes, while in the United States, the reverse of the tide starts with the tapering. So that's the timing. In terms of comparing the timing, I think we should compare the first rate hike of the Bank of Korea, which is likely to be late this year or early next year, against the start of the tapering of the United States, meaning that when they will scale back that $120 billion asset purchases. And Bank of Korea, of course, noticed that very well. I sometimes learn from them. And even the media is now catching up on comparing the Bank of Korea's interest rate increase with the Fed's, the asset purchase changes.
Well, there's a lot more to watch for and observe, I suppose, as the months continue to progress and the data. Many market observers around the world will be watching that. And well, I'm afraid this is where we'll have to end the interview today. That was Andrew Levin, Professor of Economics at Dartmouth College, and Kim Jin-woo, Professor of Economics at Korea University. Thank you both so much for your insights today.
Thank you.
Thank you.
And to our viewers, as always, thank you very much for watching.